All right, thanks, Dave, for the intro, and I appreciate the opportunity to be here and speak to you guys about a topic that probably some of you haven't even thought of, and it's really kind of the debate on whether or not, if you're speculating, you should be using the futures markets or stocks. Before we get started, just want to make sure you have all my contact information. Should you have any questions, comments, concerns about anything that we talk about today, you can reach me by email at cgarner@dcarleytrading.com. If you're on social networks, I'm on Facebook and Twitter. Facebook, search DeCarley Trading. On Twitter, my handle is Carly Garner. And like Dave mentioned, I've written a couple of books. Some of the stuff that we talk about today is in Trader's first book on commodities. If you're interested in currency trading or option trading, you may want to check out some of the other books. And I'm actually in the process of writing a book right now, which is going to be a little more focused on actual trading strategy and market analysis and those sort of things. So it's my job to remind you that there is a substantial risk of loss in trading futures and options. There are no guarantees. There's no easy money. Trading is not suitable for everybody. Okay, the question of the day is there an optimal venue for commodity speculation? The truth is, most people migrate to what is familiar, and familiar is usually stock products. So if they're looking to trade commodities, a lot of people just simply go to the ETF, the electronic traded funds. For example, in gold, they might look at GLD just because they already have a stock account open. It's there, they know the symbol, and they know the process of buying and selling it. But just because it's convenient doesn't necessarily mean that it's the best alternative. In fact, we're going to talk about today why futures trading may be a better alternative. And I just want to reiterate, I'm not talking about investment dollars. We're talking about speculative dollars. So I'm not saying you should put 100% of your retirement account in a futures trading account because it's more efficient than trading stocks or ETFs. All I'm saying is if you're going to speculate in commodities with a small portion of your portfolio, it's a lot more efficient in the futures market than it is the stock market. And that's true whether you're using commodity ETFs or you're buying individual stocks like gold miners or energy companies or things like that. Now we're going to talk about advantages and disadvantages because there's definitely some advantages to the stock arena and some disadvantages to futures, so it's not all one-sided. But I want to give you, you know, kind of the both sides of the stories, and you can decide which is going to work best for you. Another thing we'll kind of discuss today is using a traditional, even if you do decide to trade futures as opposed to stocks or ETFs, it may not be the best idea to use a traditional stockbroker. And what I'm talking about is a broker-dealer. So really the bottom line is if you are trading futures with the same brokerage firm that you're trading your stocks, you're not trading with somebody that specializes in futures. You're trading with a stock brokerage firm that decided to offer futures as a side product, but it's not really what they do, and they're probably, honestly, they're probably not that good at it. It's kind of like going into a Chinese restaurant and ordering a cheeseburger. It's probably on the menu, but that doesn't mean they're good at it. Okay, before we can really discuss this in full, we need to make sure everybody understands what a futures contract is, and I'm sure most of you do, but let's just reiterate. What is a futures contract? A futures contract is a legally binding, standardized agreement to buy or sell a commodity, specifying a quantity and quality at a set price on a future date. So a futures contract is basically an agreement to buy or sell, which means make or take delivery of the underlying commodity at a specific point in the future. The key to a futures contract is the fact that it's standardized. Because it's standardized, we're able to trade it on an exchange as opposed to in between two individual people. In other words, people that are trading futures contracts on exchanges, there's any particular buyer or seller is fungible. So they don't, you know, they don't have to. In other words, they don't have to negotiate a deal with somebody individually. They just enter an order to buy or sell, and somebody randomly takes the other side of the trade, and they will probably never know who's on the other side of the trade, and they probably don't care. But because of the standardization, and because we can easily buy or sell these commodity contracts, the markets are extremely liquid, and it's extremely efficient. And the beauty of the futures contracts is you're actually speculating on the price of the underlying commodity itself, because these are agreements to make or take delivery of the commodity. So unlike an ETF or some other type of stock product that either mimics or is related to a commodity, this is the real deal. You're trading the actual commodity. Now, the reason futures markets work is because they are deliverable, and that means if you held it all the way to expiration, you would actually make or take delivery of the underlying commodity. Now, nobody really does that, or I shouldn't say very few people do that. Only about 3% of all futures contracts are actually taken down to the physical delivery process, and the other 97% are simply offset. So if you buy a corn future, that doesn't mean that you absolutely have to accept the corn at the end of the contract life. You just sell the contract and you move on to the next trade. And a lot of stock traders that are interested in possibly moving over to commodities, they get a little bit nervous about the futures market. They're worried about, corn being delivered to their front doorstep, and that sort of thing just really doesn't happen. Your brokerage firm will be pretty proactive in making sure you know when the dates are and making sure you get out before it gets into the delivery process. And if it does happen to go a little too far, it's still not the end of the world. Your broker will retender it for you. It might cost you $100 or maybe $200, but it's not going to be the end of the world. It'll just be an expensive lesson. So don't let that deter you from the futures markets. Okay, let's talk about the similarities and differences between futures and stocks. The similarities are they're exchange traded and they're speculative vehicles. And similarities kind of stop there. There are obviously a lot of differences between stocks and futures, and we're actually going to go through and chat about each one of these things, but here's kind of a primer. There's difference in the time horizon that you hold the trade, market liquidity, the cost of leverage, tax treatment, which is a big deal for most of us, ease of buying and selling in any order, low account minimums, efficiency, we've already mentioned that, but I want to make sure you understand that, and dividends. And we're going to talk about advantages and disadvantages of trading commodities and futures. So again, we want to make sure you get both sides of the story. The biggest difference between purchasing stocks and purchasing futures is that one is an asset and one is a liability. When you're buying a stock, you're purchasing ownership of a corporation. It's an asset. You own something. You own more than just a piece of paper that the stock certificate's written on, or nowadays it's really just on your computerized or on your statement or however you want to mention it, but you actually own something. When you're buying a futures contract, you're entering into a contract to take delivery of a specified commodity upon expiration of the futures contract. So you're not really buying the underlying commodity, you're just buying a contract that says that at some point in the future you'll buy it. So this is a liability. When you're trading futures, you're trading liabilities. When you're trading stocks, you're trading assets. So let's talk about some of the advantages of speculating in commodities using the futures market. You can easily buy or sell in any order. A lot of you are familiar with this concept, but some of you might not be. Futures traders can quickly and efficiently buy or sell a contract in any order. They can sell high and buy low. They can buy low and sell high. Hopefully they don't sell high and buy higher, or vice versa, but you get the idea. You can sell a futures contract before you ever own it, or before you ever think of owning it. If you're bearish and you think the market's going down, you sell a futures contract. Most stock traders are unable to sell a stock to enter a bearish speculation. So if they think, let's say they think the Twitter stock is going to go lower, most people cannot simply sell the Twitter stock and hope that they can buy it back at a lower price later, although some people can. Those that do have those privileges probably have a pretty sizable trading account, and on top of it, they have to borrow shares from their brokerage firm, and then they have to pay their broker interest for the luxury of doing so. But in commodities, it's not like that. You don't have to worry about borrowing shares. You don't have to pay any interest. You just sell it. It's simple. You click a button and you're done. Which brings us to the conversation of free leverage in the futures markets. Now, obviously, leverage can be a good thing or a bad thing. Leverage works both ways, but what leverage really does is kind of supercharges your profits and losses. So it's important that you don't abuse the privilege of leverage, but the fact that commodity markets have it built in and they grant it to every trader regardless of the size is definitely an advantage in flexibility. It creates a problem for those that can't or have a hard time managing their risk, but I'd say that most people would argue that free leverage is probably a good thing as opposed to a bad thing, but everybody's different. Just like some people can live in Las Vegas and some people can't. It's the same type of idea. So in the futures markets, if a trader wants to put on a position, they're granted leverage, and all they have to do is post a margin requirement. That's basically a good faith deposit. The leverage is provided by the exchange and the market itself. No charge. There's no interest for margin in futures. It's free and it's abundant. For example, the current margin for crude oil futures is about $38.50. One crude oil futures contract represents 1,000 barrels of oil. Assuming that crude's at $35 a barrel, which is actually a little higher now, but if it was at $35, that contract would be valued at $35,000. So a trader really only has to put down roughly 10% of the contract value to participate in the profits and losses of that contract. And if you think about it, if you're only putting down $38.50, but you're making or losing money based on $35,000 worth of a commodity, you can make or lose a lot of money very quickly. That's leverage. We've all experienced it with our house. We put 20% down on our mortgage, but we're making or losing money on that 20% based on the full value of the house. It's the same idea. Stock traders can do this. They can trade on margin, but they have to pay interest to their broker for access to leverage, and they probably have to have at least $100,000 in their account or more. Not all brokers will provide leverage privileges. Another benefit of trading futures is the expanded trading hours. Most futures markets are liquid nearly 24 hours per day. As a commodity broker, such as myself, this is both a blessing and a curse. It's great because I make money on commission. If people can trade 24 hours a day, there's a chance I'll make more commission than I would if they can only trade during the regular trading hours. But it also means I'm on call 24 hours a day. With that said, as a client, it's great because you can react to if something's going on in China or if something is going on in Europe, you can react to any global situation around the clock. Most stock traders must execute in the primary trading session, and that's from 8:30 a.m. to 4 p.m. Eastern. Now, there are after-hours trading, but from what I can see, they're pretty limited. Not everybody has access to them, and they're pretty thin in a lot of cases. The futures markets, I just want to mention, both the futures and the options on futures markets are open almost 24 hours a day. Every market's a little different, but most of them only pause for about an hour. So with that said, the futures are liquid, relatively liquid around the clock. You shouldn't have any problems getting in or out of most futures contracts that are trading around the clock. The options are a little bit different. Some option markets are liquid overnight, some aren't. So you want to be careful with that and just be aware of the fact that if you are trading options 24 hours a day, you're probably not going to get the best fill quality in the overnight session versus what you would get during the day session. The commodity markets are extremely efficient. When I say commodity markets, I'm referring to futures. As we've already mentioned, commodity ETFs are not necessarily efficient because you're not actually trading the commodity. You're trading a fund of derivatives on the commodity, and it gets complicated. Futures traders are buying and selling agreements against the actual commodity. Thus, they're exposed to extremely efficient price changes. In other words, it's a pure speculation. If you're long oil and oil goes up, you make money. There's really nothing else interfering aside from transaction costs. And you will have to roll over the contract from time to time because futures contracts expire. But generally speaking, your speculation is going to follow the price of that commodity. If you're trading commodity sector stocks like miners, oil companies, etc., you're facing company-specific risk, and that's noise. You know, a lot of times gold will go up, but the miners are going down because of something else going on, or one particular miner stock is going down because of something that's only specific to that one company. So if you want to speculate in the commodity, you might as well go in and do with a pure speculation using something that's actually going to move along with that particular commodity. If you've ever traded ETFs, especially the ones that are leveraged, sometimes you'll see the 2 times and the 3 times leverage ETFs. They don't always follow the price of the underlying. I've dabbled around with them. You know, maybe it was just bad luck on my part or bad timing or just my personal experience. Maybe, you know, but from what I experienced and based on what I've heard from others, a lot of times the ETFs really don't follow the price of the underlying commodity because of things like fund rebalancing and redemptions and administrative costs. My experience was with the UNG, which is a natural gas ETF. Natural gas moved, I don't remember the exact numbers, but natural gas was up 10%, and I think my ETF was up maybe 1% or 2%. So I was hanging on to all this risk and not really a lot of reward. I'm sure, you know, maybe sometimes it also goes the other way. I'm not sure, but me personally, if I want to speculate in a particular commodity, I want my profits and losses to reflect whether or not I'm right or wrong, not just something random like rebalancing or administrative costs or things like that. The great thing about trading commodity futures is that there are low account minimums. A futures trader enjoys very small barriers to entry. In fact, a lot of futures brokers will let you open an account with as little as a few $1,000. Stock speculators can open small accounts like that. I'm not saying they can't, but if they're looking to do something aggressive, active day trading, swing trading, particularly with leverage, most brokerage firms are going to ask at least $50,000 to $100,000 just to get your foot in the door. And again, futures traders can start with a couple thousand and get going. I'm not saying they should open with a few thousand. In fact, with the leverage that we see in the futures markets, opening with a couple thousand doesn't give you very big odds of success. But I'm just saying you can, just to give you an idea of the difference between the two arenas and what kind of opportunities are there for different sizes of traders. A smaller trader probably would have a really tough time doing what they want to do in the stock market. If you've ever come to any of our previous webinars, you've probably picked up on the fact that we like the idea of option selling. It's a different stance. Most brokerage firms decline accounts that want to sell options, or if they do accept them, they hold them to particular, you know, restrictions and other types of preventative measures. But we do like the practice of option selling in the long run. I think it's probably about the best way you can approach the markets. In the short run, it can be really tough, just like any other strategy. But with that said, option selling is not open to all stock traders. Stockbrokers generally require $50,000 to $100,000 to sell options. And to make it even more expensive, they require enough cash to accommodate an exercise. So if you want to sell an option in stocks, you have to have enough money to pay for the stock outright if you're ever exercised. And in some cases, we're talking tens to hundreds of thousands of dollars in additional money for really no other particular reason other than maybe on the off chance you get exercised, you have to have the cash in there. In futures, it's not like that. Commodity futures, option traders with relatively small accounts can sell options as they wish as long as they have the required margin. And the reason there really is not a requirement to hold, to manage a possible exercise is because if a futures trader sells an option and they're exercised, they're simply delivered the futures contract, which is leveraged. So they don't have to have the entire outlay required to purchase the commodity contract. So for example, in crude oil, we said if crude's at 35, the value of the contract is 35,000. Well, it's not necessary to have $35,000 in an account to sell a crude oil option. You might be able to get away with it with a couple thousand. If you're assigned the futures contract, then you'll have to have the margin of 38.50 to hold that futures contract, but you don't have to have 35,000. So you can see how the commodity markets open the door to option selling to people that couldn't afford it in stocks. Another benefit of trading options and options on futures is portfolio margining. Portfolio margining is available in stocks. People that are trading option spreads or covered calls, those types of things in stocks, they do get portfolio margining, but only if their brokerage firm approves it. And generally, from what I've seen, they require about $100,000 in the account to do it. In the futures markets, all accounts are granted portfolio margining. Whether you have 2,000 or 200,000, you get portfolio margining. And portfolio margining is great because if you're, for example, if you're an option seller, you can sell a call and a put in the market to create a strangle, and you're really, in its simplest form, you really only charge a margin on one side of the trade because you can only lose on one side of the trade. If you were trading an option account and you did not have portfolio margining, you would be charged margin on both sides of the trade. And you can see where it'd be pretty big inconvenience to pay double the margin, even though you couldn't lose on both sides of the trade. A big difference between stocks and commodities is also the time horizon that most people will hold positions. This isn't necessarily an advantage to futures trading. In fact, it might be a disadvantage because futures contracts do expire. Thus, the length of time that a single position can be held is pretty limited. The great thing about trading stocks, the advantage that they might have, is stocks can be held in the very long term. And if a short-term trade gets away from you and you're long-term bullish, you can pretty much hold on to that trade almost forever until hopefully it comes back, unless the company goes bankrupt or whatever the case is. But stock traders do have a little bit of an advantage in that they can hold indefinitely, where futures traders really cannot. With that said, futures traders can always extend their position. So if their contract is expiring, they basically would just sell the contract they're in and then buy another contract with a distant expiration date. So in theory, if futures traders were willing to continually roll over, they could hold their position forever. But the disadvantage of that would be they would probably get caught up in the contango, which means the contract that they're getting out of would probably be a cheaper price than the contract they're buying into, and over time that would eat into their profit potential a little bit. So that's one disadvantage of futures over stocks. And probably, maybe, I don't want to say the biggest advantage of trading commodity futures as opposed to stocks, but it's right up there, is tax treatment. Futures traders receive dramatically favorable tax treatment. First and foremost, they get taxed at a 60-40 blend between long-term and short-term capital gains. But even better than that, or maybe just as good, is the easy-peasy filing. They report a single figure to the IRS from a 1099. So in other words, their commodity broker will send out a 1099. It's going to give them one lump sum, profit or loss. They take that number, they report it on their tax return, and that's it. But stock traders are not that lucky. Stock trades must be reported, each individual trade must be reported to the IRS. And as you can imagine, it can take a long time to input all of that data into your tax return. Then on top of that, once they do get it into their tax return, they're most likely going to be taxed at a short-term capital gain rate, which is higher than the long-term. Anything held less than a year, they pay short-term capital gains. And remember, futures traders, even if they're holding for 5 minutes or 10 minutes or even less, they're paying a 60-40 blend. Okay, let's talk about a couple of disadvantages. In addition to not being able to hold forever, I should have had that slide in this section, but clearly I goofed. But a disadvantage to futures as opposed to stocks is liquidity. There are, it's obvious, there are a lot more stock traders out there than there are futures traders. There are really only about 30 futures markets that are liquid enough for trading. And of those 30, I would say only 10 of them are highly liquid. The other 20 are, maybe somewhat sparingly as far as how often you should venture into them. With that said, I mean, there are some speculators, and we have some clients that are extremely experienced and extremely knowledgeable about certain markets that aren't necessarily liquid, and they do well in those markets. So that's okay. If you have some sort of specialized knowledge in lumber or milk or whatever the case is, and you think you can make some money there, go for it. I'm not telling you shouldn't, but for the average trader that has a basic knowledge of the commodity markets, it's probably not a good idea to get involved in the illiquid markets, because there really isn't a lot of room for error, and there's just no mercy. If you are wrong and you're in a bad trade, it can be pretty painful. So there are even fewer liquid option markets for option traders. And when I'm referring to the 30 markets above, not the 10. I would say there's about 10 good liquid option markets in commodities. You can trade another 5 to 10. So there's probably 20 available that are worthwhile looking at. But as far as the really good liquid ones, there's probably only about 10. This is obviously a lot different than stocks. In stocks, there are hundreds of listings that are liquid, and there's, most of those have options attached to them that are fairly liquid. So it's a little bit different when it comes to liquidity. You have to be really careful, especially if you're venturing from stock market with the assumption that most are liquid enough to trade. When you get into commodities, just be sure to be looking at the open interest and the volume, and more importantly, the bid-ask spread. If there's a wide bid-ask spread and you can't efficiently get in and out of the market, you probably just leave it alone. And the big elephant in the room is dividends. Commodities do not pay dividends. There is no type of cash flow until the trade is offset. Well, the great thing about dividends is they cushion losses. There's that income, so if you're wrong on the price of the stock, but you're getting a dividend, at least you have that cutting in and buffering your losses. Commodity traders have no such luck. They are on their own. Their profits and losses are left only to the direction of the market. One more thing to keep in mind, and we kind of mentioned this a little earlier, but I just wanted to make sure everybody understands. If you're going to trade futures, make sure you do it with a futures broker. Don't do it with your stockbroker, because what will happen is, it might not be today or it might not be tomorrow, but eventually you'll have some sort of problem with, maybe it's a platform outage or an internet outage, or you just have a question and you need to get a hold of someone to answer that question or to help you get out of a trade. And if you're trading with a stockbroker, you're probably going to have a really hard time getting someone on the phone that knows futures, understands the markets, and will be able to get what you need done quickly. And with so much leverage in the futures markets, a 5-minute hold time or a 10-minute hold time could mean hundreds of dollars in losses. So you really don't want to put yourself in that situation. Just because it's convenient to trade a futures contract out of your stock account it's probably not a good idea. Some of the other differences, is, aside from just having someone that can support your futures trading, is a lot of the stockbrokers will charge higher margins, and that's for overnight margins, that's for option margins, and that's for day trading margins. So you're going to get much more favorable margin rates if you trade with a commodity broker. For the most part, I'm just generalizing. It's not always the case. Just do your homework. But generally speaking, you will get better margin rates. And it's not because the broker themselves is offering lower margins. It's because futures brokers generally offer the exchange minimum margins, but stockbrokers tend to charge what's called an upcharge. So if the exchange minimum margin on a particular commodity is 4,000, a lot of the broker-dealer or stockbrokers, they'll charge you 5 or 6 just because, to be honest, they want to buffer their risk. Another big benefit of trading with a commodity broker is if you do happen to trigger a margin call, hopefully somebody can help you manage that. There's ways to adjust trades. You can sell options, you can buy options, you can roll things around. But if you're trading with your stockbroker, they're going to have absolutely no idea how to help you other than liquidate your trades. In fact, they might liquidate your trades without even talking to you or asking you or mentioning it to you. And this happens all the time. So be sure you're with a commodity broker that's willing to work with you. Okay, thank you everybody for coming out. We appreciate your support. Be sure to visit our website, thecarlytrading.com. We are a futures and options brokerage firm. That's what we do. If you have any questions, feel free to ask them now.
All right, let's just go through some questions here. Carly, in terms of getting started trading, assuming that, let's just do the math here and just assume that most of the people here are not profitable traders, as that would be likely. Stocks versus commodities, you think there's any benefit, difficulty? If you're new to trading, one would be better than the other?
I think it really depends on what exactly you're trading. Like if you're interested in trading commodities or commodity-related stocks, I would say futures markets are going to be your best bet. But if you're, for some reason, you think you've got a handle on individual stocks, obviously stocks might be the better venture for you. The one thing I can say is the futures markets do offer more leverage, so that can be a good or a bad, depending on your personality. I would highly recommend that you open paper trading accounts, maybe even in both arenas, stocks and futures, and just kind of try things out so you get an idea of how the prices move and whether or not your trading strategy or ideas are going to work well in that particular arena.
Again, we'll stick around and answer all your questions. In regards to a new trader and leverage, I mean, obviously one tick in stocks is only $1 on 100 shares. Mm-hmm. And obviously one tick is significantly more when we're dealing with futures contracts here. Is there particular contracts that maybe, again, a new trader who's trying to figure it out, trying to have small losses as they're figuring out, that might be ideal for them?
Yeah, absolutely. On the futures side of things, the leverage makes it possible to make money more quickly or lose money more quickly, so that's definitely an advantage there. But if you're just getting started, if the goal is to day trade, which is a whole different animal than swing trading or position trading, if the goal is to day trade, I would start with the mini NASDAQ. It's $20 a point, and of course, the NASDAQ does have its days where it moves 30, 40 handles, but generally speaking, even if it moves, let's say 30, that's a $600 profit and loss. That's a lot of money, but it's a little tamer than the E-mini S&P. Or they could try trading spreads between the NASDAQ and the E-mini S&P. That's one way to curve some of the risk also. So if they get a buy signal on their day trading method, they could buy the E-mini S&P and sell the NASDAQ against it and do some sort of a spread. But if their goal is not necessarily day trading but position trading, there's a really great way to get started for beginners, and the CME, the Chicago Mercantile Exchange, offers a suite of e-micro currency futures. The margin on them is only anywhere from $100 to $250, somewhere in there for most of them. So the margin's really low. You're only going to make or lose $1 per tick on a trade, but if you catch a ride, it could add up to several $100 or in profit and loss. So, but it's just a great low margin way to get involved. It's kind of like paper trading because you're not really going to make or lose a whole lot of money usually, but you at least get the emotional feel of it, and you get more of a realistic, you know, clue as to how your trading method would work.
Earlier you were talking about leveraged ETFs. So in general, I believe this to be true of all leveraged ETFs, that they are rebalanced daily. So if you if you're holding for a month a 3 times leverage ETF, and and that ETF or the underlying ETF is up 10%, you're not going to make 30% if the daily ups and downs don't match what's going on. So if you have slight gains up and your down days are huge or 3 times the size as your up days, you're not going to make any money because, again, it leverages each day and you're basically getting that leverage each day. I'm not exactly sure if you're holding it, if where the overnight counts, which day follows over, but that's why a lot of people are ignorant about buying leverage ETFs, thinking you're just going to hold it and make 3 times what the spiders are doing with the 3-time leveraged ETF, and that's not how it works. It's really more for day trading. So, which brings up a good question of holding periods. So, any advantages here, disadvantages? What type of time frame, particularly new traders, what should they be looking at here?
Okay. As far as the futures markets goes, most of the financial products are on a quarterly cycle, meaning they expire every 3 months. So 4 times a year they roll over. In those particular contracts, really, you can. I mean, we have some traders that hold positions for months. They'll just, if the contract's expiring, they roll into the next one and they keep going. Now that's hard to do for some people on leverage because there's leverage built in. It's not as comfortable as buying into an S&P, the SPY or whatever the case is. When you're buying the E-mini S&P, you're making or losing $50 per point, and on the smaller accounts that ends up being pretty volatile. So it just depends on your funding and your accounts, your comfort level and that sort of thing, but theoretically you could hold forever as long as you're willing to roll over and you didn't mind the, being eaten up a little bit every time you roll over. In some of the commodities, like crude oil, rolls over every month, and so that's a little bit more of an obstacle to try to hang on for the long term. I would venture to say that most commodity traders are generally trying to hold a position anywhere from a week to maybe 3, 4, 5 weeks. Most of them don't try to go beyond that because of the leverage. It can be, it can be pretty expensive to hang on to something for the long haul. But everybody's different. It really boils down to what their personality is and what their funding is and that sort of thing.